Every pro trader knows this truth. How you exit a trade is even more important than how you enter. If you don't know when to get out, you're leaving serious profits on the table, or even worse, giving them back. In this video, we'll teach you the 4 most effective trailing stop exit strategies used by top traders, so you can protect your P&L and exit with confidence. I'm Mike Bellafiore, co-founder of S&B Capital, one of the top proprietary trading firms in the US with offices in New York City and Miami. We've developed numerous 7 and even 8-figure per year traders, and we share what works here at S&B Capital on our YouTube channel. You found the right place to help you grow your trading account. Let's get started.
If you're a trend or momentum trader and you're not using trailing stops, you may be leaving a lot of money on the table. We'll review 4 different styles of trailing stops and outline exactly the types of situations these stops are best for. I'll provide some real examples of how I use these trailing stops in my systematic trend and momentum trading for intraday and swing trades. And I'll also tell you a story about a trade that ended horribly, an experience that became a pivotal learning point in my career. If you're new here, I'm Garrett. I trade discretionary strategies and fully automated trading systems on the New York desk. So what is a trailing stop? A trailing stop is a type of stop that automatically adjusts to market movement, following your position when the market moves in your favor. Trailing stops sound great, and often they are, but the type of trade that you are applying it to matters, and the kind of trail that you use matters. And I'll get into this in a second. Why do we use a trailing stop? Some traders treat trailing stops like full-blown strategies. You'll hear stuff online like, this trailing stop gets a 65% win rate, so on. This is not true. A trailing stop alone is not a strategy. You will need a great trade to have edge. However, a trailing stop can be a wonderful tool for managing your trade and maximizing its inherent edge. So allow me to get into this. There are 2 significant problems a trailing stop helps solve, right? So number 1, you sell too early. You can't stay in your best trades, right? We've all been there. We nail an A+ trend trade. It starts to work in our favor. We get too zoomed in on the trade at the onset, selling too much on the initial move at any sign of slowing momentum or trouble on the tape. And we watch it trend all day or for multiple days, and we're left with a fraction of the size we started with. A trailing stop can provide a system that helps us hold well in trending stocks and realize significantly more profit. The second problem, you overstay. You freeze up when a trade starts to reverse, right? We've all been there too, right? We do a great job of holding size, experience significant open profit and a great trade. And when it starts to move the other way, our conviction and bias interfere with our ability to listen to the market. We make up things in our head like, well, if it pulls back here, I'd want to buy more anyway, so I can't get out here. Or, hey, I didn't sell at the top, so I'll just wait and see what happens. A trailing stop can provide a system that helps us detach from outcomes and exit our trades, saving a large amount of open profit. Implementing a trailing stop as part of a systematic process solves both of these problems. I know this because I've dealt with the pain of both of these scenarios and was forced to come up with a solution. So let me tell you a story. Years ago, I nailed a beautiful IWM breakout trade. It had consolidated in a tight range for months. It broke out on elevated volume, a 2 standard deviation daily volume bar. Right? Given the length of the consolidation and the macro backdrop, I had lofty targets for this trade. As trend traders, we want to have a healthy imagination. This is good. There's nothing wrong with visualizing a sustained trend when our trade is set up for one. But we have to stay flexible. So over the next week, we got a nice momentum move from 230 to 244. As far as I was concerned, this was a sign that the trade was working. We had a nice open profit, but had bigger ideas for where this could go, right? This could trend for weeks. We thought that over the next few weeks, we could see 260. After all, a measured move target, which would take time, of course, could bring this to 300. right? Not out of the question. So over the next week, IWM pulled back. So great, healthy pullback, right? We can't possibly sell here if we didn't sell at 244. Another week goes by and IWM fails to reclaim. It starts to break lower. Okay, well, maybe they're just making this difficult, right? We can't sell here because it's just retesting the breakout level now, right? These thoughts were blinding us to the deteriorating relative strength in IWM and the deteriorating breadth in the overall market. So another week goes by. Okay, now we're retesting the breakout level in the 50-day moving average. It should hold here for sure, right? We go home for Thanksgiving, and we wake up on Black Friday to a 2.5% gap down. Ouch. This is a great way to ruin your Thanksgiving. We turned a significant profit into a substantial loss. So overall, this was a great lesson. We had to go back to our methodology and figure something out so this wouldn't happen again. We had to find a way to manage a trade like this systematically because anything can happen. And we're just trying to stack the risk reward and odds in our favor. Ultimately, we want to find a way to stay in the best trades and detach ourselves quickly from the trades that are not working. So we added a trailing stop methodology to this trade and have been using it ever since. I can't tell you how many profits the lesson from this one loss has saved us. It was a blessing in disguise. So we went back and studied this specific setup, all the trades in our playbook, and asked ourselves, how do the ones that truly follow through act as the trade develops? What levels do they hold? When do the ones that fail start to show that they are failing, right? To this day, for any trade in this specific playbook, which is made on a significantly higher time frame than most, we trail the trade using a 10-day simple moving average. If the stock can't hold the 10-day, we are gone. For us, this means that if the stock closes below the 10-day, we're cutting the position. You can navigate this in a few ways depending on your style, and I'll get more into the nuances of this later in the video, right? So you can cut half of the position on a close below the 10-day, and you can cut the rest on a break of recent support. The key is that there's a system in place. A trailing stop system like this can consistently save us from ourselves, trade after trade. Now, there are several different types of trailing stops we can use. The type we use will depend on our trading style and our goal for the trade. So let's go over these different options. So a bar trail is my favorite trailing stop when you're looking for sheer momentum. This style of trailing stop should be reserved for when you have a significant price pattern accompanied by volume, a trade in which you're expecting a powerful initial move and want to capture that initial momentum and then exit the trade. We implement a bar trail by raising the stop for our trade below the prior bar low for a long trade and above the prior bar high for a short trade. For example, we have a significant breakout level at 1150 as price tightens on the 30-minute chart. Intraday price consolidates above 1150, right? And significant buying volume comes into the stock. In this situation, we may only be interested in capturing initial momentum as volume flows into the stock. If we expect this move to have power, we can get away with implementing a bar trail. In this case, we would enter on the break of 1180 when the volume comes in, and that's the blue line there, and trail using the prior 2-minute bar, and that's the magenta line. We would exit on the prior bar break 4 bars later. This would have saved us from holding for a full loss on the trade due to a complete failure. Bar trails are my go-to when I size into momentum breaks. This allows me to have a very close stop and a trail that will tighten quickly in a trade where I expect unusual momentum. This SMCI backside short trade is an excellent example of this. We short the opening range break. Because of the context of this trade, the volume on the break, and the potential for A-plus momentum, we trade this with size and trail our momentum portion using prior 2-minute bars. This allows us to keep this portion tight. If it's got juice, it'll keep us in the trade. Now, you have some options with the bar trail. You can wait for the bar to close, or you can get out intra-bar. For example, on this short trade, if you wait for the bar to close, you will require the bar to close back above the prior bar. On the other hand, if you react intrabar, you will exit on any print above the prior bar. I prefer not to wait for the bar to close because I only use a bar trail for pure momentum. Just get me out and move on. The other option that you have is the time frame. I'm using a 2-minute bar trail here. This is my favorite intraday pure momentum bar trail time frame. It will get us out quickly, right? I would not go lower than this, but sometimes I will use a 5-minute bar trail or higher. So if we go higher, we're going to widen the stop. A 5-minute bar trail will be more robust. It will keep us in longer intraday moves, right? I'm likelier to use a 5-minute bar trail on an opening drive, especially on a breakout, because these can trend for a while. And a 15-minute bar trail will keep us in full intraday trends. If we think something can trend all day, we can use a 15-minute bar trail. Of course, the higher the time frame, the longer the potential trend and the more potential give back in the trade. So that's the trade-off. So I find it best to study these and figure out what is best for the play you're making. A bar trail will be the tightest, most momentum-based trailing stop we will use. Because it is so tight, it will also be the noisiest. This means that if the trade doesn't give us sheer momentum, when we use this trailing stop style, we will likely get whipsawed out of the trend. So I reserve it only for the most explosive intraday volume breakouts. Other trailing stops we can use will act more passively in our position and help us stay in trends. An ATR trailing stop is my favorite trailing stop for staying in the trend. This will be the most passive style of stop. It tends to flatline as price consolidates, so I place it on the other end of the spectrum from the bar trail, right? While we use a bar trail to capture pure momentum and exit immediately, we use an ATR trailing stop to stay with trends as long as price holds. If you want to hold longer for bigger moves, use the ATR trail. An ATR trailing stop dynamically adjusts based on the market volatility. It uses the average true range indicator, which measures the typical range per bar, and it adjusts the stop level by a multiple of that ATR. Just like any of these trailing stop options, the time frame you use depends on your trade. There'll be parameters for an ATR trail, the ATR period and the ATR factor. The ATR period determines how many bars back the indicator will look to calculate the ATR and find the price from which to extend the stop. The ATR factor is the multiple that will adjust how many ATRs the stop is from price. The higher your ATR period, the slower the indicator will react to volatility and price changes. The higher your ATR factor, the wider your stop will be. I like to use 3 for both parameters. There's no magic number. I suggest experimenting with it yourself for your specific setups. But we use these trailing stops in a few of our automated strategies, and we like 3 and 3, so we stick with that. So here's a trade one of our models took on Friday. This model utilizes the ATR trailing stop on a 5-minute chart. Notice how the ATR trail will always flatline as price goes sideways. This is why it is such an excellent tool for staying in the trends. You can try this on multiple time frames. The lower the time frame, the shorter the trend, of course, right? Here is QUBT from Friday on a 2-minute ATR trail. You can see that it gave it a shot to move higher for as long as it could before it trailed out. When we use an ATR trailing stop, we wait for a bar close below the trailing stop. So nothing will be perfect, right? No trailing stop is going to get you out at the highs, of course, and sometimes there will be whipsaw. And this is why understanding our trade and applying the appropriate trail type is essential. For example, here's the Tesla 295 breakout from last Friday. Price had been tightening below the breakout level on the 130-minute chart. This is a trade where volume came in above a significant breakout level at the open. There was an opening drive, momentum trade, and a longer-term swing trade opportunity. We might want to use a trailing stop for a portion of the trade to capture the momentum on the opening drive And we might want to hold a portion for the swing trade. In this case, we could have used a 5-minute bar trail to manage the opening drive and then trail the rest with an ATR trailing stop on the 15-minute chart. Of course, it won't get you out at the high, as no trailing stop does, but it could have helped stay in a nice 4-day move while keeping your open profits reasonably protected along the way. And this is what we did. So there are a few other trailing stop types that we can use, which will be somewhere between a bar trail and an ATR trailing stop. This means that they will be more forgiving than a bar trail, less noisy, a little bit easier to stay in the trade, but they will rise more persistently than an ATR trail, right? Getting out of the trade when price starts to stall. Because of this, they won't save us as quickly from a reversal as a bar trail, and they won't help us stay in a significant trend quite as well as an ATR trail, but they will capture a middle ground. And because of this, you might find that they suit your strategy well. One such trailing stop is an exponential moving average. As you can see here in our Tesla example, waiting for a close below a 9 EMA does almost as well as the 5-minute bar trail, but with less risk of getting wicked out on a bar that doesn't behave. We have an automated model that trades these opening drives based on the 9 EMA. I find that the 9 EMA does a fairly good job of capturing the momentum that a strong opening drive tends to deliver. A parabolic SAR is another type of trailing stop. It rises more aggressively as time passes. You'll find it on most platforms. In our Tesla example, you can see that the parabolic SAR will aggressively tighten the longer we are in the trade. For this reason, it's not a great trailing stop for staying in longer trends because it's impatient. But it starts out wide, and as time passes, it tightens up. In this case, the parabolic SAR got us out in a very similar place as the 5-minute bar trail, but it gave the trade much more room to move at the beginning. And this is really the point of the parabolic SAR. Again, this can be a nice middle ground. There are two parameters for the parabolic SAR, the acceleration factor and the acceleration limit. The acceleration factor is a multiplier that influences the rate of change of the stop. And the acceleration limit sets the limit to how tight the stop can get. The stop will gradually tighten at the rate set by the acceleration factor until it reaches the acceleration limit. Each of these trailing stops will act differently, so it pays off to have an idea of your goal in the trade, how you expect the stock to move, which approach for your specific strategy will yield the best results over time. We figure this out by studying our strategies, finding many historical examples, and paying attention to how the stocks move when they act well. As I mentioned before, a trailing stop does not give your trade edge. Right? The edge should already be there, but once we find trades with edge, they can be a fantastic way to help us manage them, exit trades when the market starts to turn, and hold trades better to capture some of these tremendous trends. Hope this gave you a few ideas to play around with. Let me know in the comments what kind of trails you like to use. If you have any questions, please feel free to post them in the comments, and I'll be happy to answer them.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills. Because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of SMB Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part, you don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.